Industrial America after the gold standard from 1970 to 2000 was a period of dramatic change. This video reviews key events from 1970 to 2000. For sources and recommended books, please check the description below. And if you find this content helpful, don't forget to subscribe, like, comment, and share. So let's get started. The collapse of the Bretton Woods system in 1971, when President Nixon unilaterally suspended the dollar's convertibility to gold on August 15th, marked a pivotal watershed in American industrial history. This monetary transformation, ending the fixed exchange rate system that had governed international economics since 1944, unleashed forces that would fundamentally reshape America's industrial landscape over the subsequent decades. Reasons behind Nixon's suspension of dollar-gold convertibility. On August 15, 1971, President Richard Nixon announced the suspension of the dollar's convertibility to gold, effectively dismantling the Bretton Woods system of fixed exchange rates. This significant decision was driven by a combination of economic pressures and geopolitical challenges that had been building for years. Economic pressures. The Bretton Woods system, established in 1944, pegged the US dollar to gold at $35 per ounce and linked other global currencies to the dollar. However, by the late 1960s, cracks began to emerge in this arrangement due to rising U.S. inflation, trade imbalances, and deficits. The dollar had become overvalued as the U.S. struggled to maintain the gold reserves required to uphold its commitment. Foreign nations, particularly European countries, began demanding gold in exchange for their dollar holdings, depleting American reserves. The Vietnam War and President Lyndon Johnson's Great Society programs further exacerbated the situation. These initiatives required massive government spending, leading to fiscal deficits and increased money supply. The resulting inflation eroded confidence in the dollar's stability and raised doubts about the sustainability of the gold standard. Geopolitical challenges. The global economic landscape was shifting. As European and Japanese economies recovered post-World War II, their industrial output surged, creating fierce competition for American goods. The U.S. faced mounting trade deficits as imports outpaced exports, putting additional strain on its currency. Moreover, foreign central banks held vast reserves of dollars and increased their demands for conversion to gold, threatening to empty Fort Knox of its precious reserves. Nixon's solution. Faced with these mounting challenges, Nixon opted for bold action. By suspending the dollar's convertibility to gold, he aimed to prevent further depletion of U.S. gold reserves and to stabilize the economy. The move also freed the dollar from the constraints of fixed exchange rates, allowing it to float and respond to market forces. In his address to the nation, Nixon framed the decision as necessary to protect American interests. "I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interests of the United States." The suspension marked the end of the Bretton Woods system and the beginning of a new era of global finance. While it provided immediate relief to the U.S. economy, it also triggered inflationary pressures and volatility in the international monetary system. Nixon's decision reshaped the economic landscape, paving the way for floating exchange rates and a shift toward financial globalization. The immediate aftermath of Nixon's decision triggered severe inflation that would plague American industry throughout the 1970s. By 1974, inflation reached 12.3%, while wage stagnation meant that real purchasing power declined for most American workers. Manufacturing costs soared as energy prices quadrupled following the 1973 OPEC oil embargo, forcing many energy-intensive industries to seek lower-cost alternatives or face bankruptcy. American steel production, once the backbone of industrial might, entered terminal decline. U.S. Steel's Gary Works, which had employed over 30,000 workers in the 1960s, saw its workforce shrink to fewer than 10,000 by 1980. The industry's problems reflected broader structural issues: aging equipment, high labor costs, environmental regulations, and most critically, fierce competition from Japanese and German producers using more modern facilities and technologies. The textile industry experienced catastrophic contraction as import penetration increased from 14% in 1970 to 55% by 1985. Burlington Industries, America's largest textile manufacturer, closed over 60 plants between 1975 and 1985, eliminating approximately 70,000 jobs. Southern states, particularly North Carolina and South Carolina, lost the foundation of their economic base as mills that had operated since the late 19th century shuttered permanently. Electronics manufacturing, once dominated by American companies like General Electric and Westinghouse, began migrating to Asia during the mid-1970s. Sony and Panasonic established the model for Japanese consumer electronics dominance, while companies like Texas Instruments began outsourcing assembly operations to Mexico and Southeast Asia, seeking lower labor costs and reduced regulatory oversight. The automobile industry faced unprecedented challenges as Japanese manufacturers gained market share through superior quality and fuel efficiency. General Motors' market share declined from 45% in 1970 to 35% by 1985, while Toyota and Honda established manufacturing plants in the United States to circumvent voluntary export restraints, beginning a transformation that would reshape American automotive manufacturing. Financial markets underwent revolutionary changes following deregulation. The dismantling of Glass-Steagall provisions, along with technological innovations in trading systems, created new financial products like derivatives and mortgage-backed securities. These developments attracted capital away from traditional manufacturing toward financial services, accelerating deindustrialization in traditional manufacturing regions. Military spending patterns shifted during the Reagan administration, from 1981 to 1989, with defense expenditures increasing from $303 billion in 1981 to $467 billion by 1988. While aerospace and defense contractors like Lockheed, Boeing, and Northrop Grumman benefited enormously, this concentration of federal spending distorted industrial development, creating regional disparities between declining Rust Belt cities and booming Sun Belt defense centers. Environmental regulations, particularly the Clean Air Act amendments of 1977 and the Superfund legislation of 1980, imposed significant compliance costs on heavy industries. Steel production, chemical manufacturing, and mining faced expensive retrofitting requirements or plant closures. Many companies found it economically attractive to relocate operations to countries with less stringent environmental standards. The rise of the service economy fundamentally altered employment patterns. Between 1970 and 1990, service sector employment increased from 59% to 71% of total jobs, while manufacturing employment declined from 26% to 18%. This shift reflected broader technological changes, including automation, computerization, and the growing importance of information-based industries. Supply chain management theory evolved during this period, pioneered by companies like Walmart and later adopted across manufacturing. These practices emphasized just-in-time inventory management, reduced warehousing costs, and complex global supplier networks. While increasing efficiency, these strategies also contributed to industrial job displacement, as companies sought the lowest-cost suppliers regardless of geography. The emergence of NAFTA negotiations during the late 1980s and early 1990s accelerated industrial relocation to Mexico. Approximately 300 U.S. manufacturing plants relocated across the Mexican border by 1995, taking advantage of lower wages and preferential trade status. The Maquiladora program enabled duty-free import of materials and re-export of finished products, creating powerful incentives for industrial migration. Information technology became the new industrial frontier. Companies like Intel, Microsoft, and IBM transformed from primarily hardware manufacturers to integrated technology solutions providers. The personal computer revolution, initiated by Apple and popularized by IBM PC clones, created entirely new industrial sectors while traditional manufacturing continued declining. Currency manipulation emerged as a significant factor in industrial competition. Japan's deliberate yen devaluation during much of the 1970s and 1980s made Japanese exports artificially competitive, while creating massive trade imbalances. By 1985, the U.S. trade deficit with Japan exceeded $50 billion, prompting the Plaza Accord, which forced yen appreciation but failed to reverse established industrial migration patterns. Containerization, really revolutionized global shipping, slashing transportation costs by about 90% between 1970 and 2000. This technological leap made global supply chains economically viable, allowing manufacturers to source components from a bunch of different countries and assemble products wherever labor costs were lowest. The standardization of container sizes and handling equipment, well, it created these seamless international logistics networks that changed everything. Corporate restructuring became almost endemic during the 1980s as companies faced much tougher global competition. Leveraged buyouts, hostile takeovers, and corporate raiders like Carl Icahn totally transformed industrial organizations. General Electric under Jack Welch, for instance, really epitomized this transformation, divesting traditional manufacturing operations, expanding financial services, and eliminating over 170,000 jobs between 1981 and 1995. Union membership, meanwhile, declined precipitously as manufacturing jobs disappeared. Private sector unionization fell from 24% in 1973 to just 9% by 2000, which really undermined organized labor's ability to maintain wage standards and working conditions. The Professional Air Traffic Controllers Organization strike of 1981 and President Reagan's subsequent dismissal of striking workers symbolized the changing power dynamics between labor and management. Chinese economic reform starting in 1978 created vast new manufacturing capacity that would eventually dominate global production. At first, Chinese manufacturing focused on textiles and basic consumer goods, but over time, it gradually moved up the value chain, attracting foreign direct investment through special economic zones and joint venture requirements that facilitated technology transfer. Automation and robotics adoption also accelerated during the 1980s and 90s, especially in automotive manufacturing. General Motors' Factory of the Future project, even though it had some initial failures, pointed toward increasing automation as a response to Asian competition. By 2000, Japanese automakers were using roughly 3 times more industrial robots per worker than American manufacturers, and that contributed to some pretty significant productivity differences. Regional economic disparities widened as traditional industrial regions suffered devastating job losses. Detroit's population, for example, declined from 1.5 million in 1970 to 950,000 by 2000, with unemployment rates consistently exceeding national averages. Pittsburgh, Cleveland, and Buffalo experienced similar demographic and economic declines, while metropolitan areas in the South and West started attracting new service and technology industries. Healthcare costs, really became a critical factor in industrial competitiveness. By the year 2000, American manufacturers were dealing with healthcare costs averaging about $4,000 per employee every year. In comparison, Japanese competitors paid around $1,000, and manufacturers in developing countries often paid nothing at all. These big cost differences, they created even more incentives for companies to move production offshore. At the same time, changes in corporate governance, especially the growing focus on maximizing shareholder value, began to influence industrial decision-making in a big way. The push to maximize quarterly earnings encouraged short-term cost-cutting strategies, like offshoring production, instead of making long-term investments in domestic manufacturing capacity or workforce development. Energy markets were also deregulated during the 1990s, which led to volatile pricing that hit energy-intensive industries pretty hard. The California electricity crisis of 2000 to 2001 really showed the risks of relying too much on market-based approaches for essential industrial inputs, while honestly, financial traders took advantage of regulatory loopholes for speculative profits. Meanwhile, education and workforce development just didn't keep up with the pace of industrial transformation. Community college programs and vocational training initiatives lagged behind technological changes, and that led to persistent skills mismatches. By 2000, about 30% of manufacturing workers lacked the technical skills needed for advanced production systems. Financial deindustrialization picked up speed as investment capital increasingly flowed towards speculative financial markets rather than productive manufacturing. The rise of private equity firms, hedge funds, and other alternative investment vehicles pulled resources away from traditional industrial lending, which contributed to the decline of the manufacturing sector. Environmental justice concerns also came to the forefront, as declining industrial areas were often left with toxic legacy pollution but lacked the resources for cleanup. The Environmental Superfund Sites program ended up identifying thousands of contaminated former industrial properties, many located in minority communities, that would require billions in cleanup costs, while offering little hope for renewed industrial development. During this period, immigration patterns shifted, with post-1965 immigrants increasingly coming from Asia and Latin America instead of Europe. Many of these new Americans found work in the remaining manufacturing industries, but often at lower wages and with fewer benefits than previous generations, which contributed to wage suppression in those sectors. Technology transfer to Asia, meanwhile, happened through a bunch of channels. Joint ventures required by Chinese government policies, university research collaborations, corporate mergers and acquisitions, and even industrial espionage all played a role in spreading American manufacturing knowledge and capabilities to potential competitors. Capital markets started to prioritize intellectual property over physical assets. For example, by 2000, companies like the famous beverage cola derived more than 80% of their market value from brand equity and patents, not manufacturing facilities. This shift encouraged even more manufacturing outsourcing, as companies started focusing on design, marketing, and distribution, rather than production. Infrastructure deterioration became more obvious as industrial investment declined. By 2000, the American Society of Civil Engineers estimated that the United States needed over $1.3 trillion in infrastructure improvements. Crumbling bridges, outdated power grids, and aging transportation networks really hurt the efficiency and competitiveness of the remaining manufacturing sector. Regulatory arbitrage also became a sophisticated corporate strategy, with companies moving operations to places with better tax treatment, weaker labor protections, and less environmental oversight. Ireland, for instance, became a popular destination for American corporations looking to minimize tax liabilities while still accessing European markets. Research and development spending shifted more and more toward software and services instead of traditional manufacturing innovation. By 2000, about 70% of corporate R&D investment was going into information technology and services, compared to less than 20% in traditional manufacturing sectors, which just widened the technological gap between American manufacturing and emerging industrial powers. Corporate pension obligations created even more pressure for manufacturing relocation. Companies with large pension liabilities, especially in steel and automotive sectors, faced huge unfunded obligations that pushed them toward bankruptcy reorganization or moving production offshore to escape legacy costs. The dot-com bubble in the late 1990s really symbolized the economy's shift away from traditional manufacturing and toward speculative ventures in the information economy. When that bubble burst in 2000 and 2001, it exposed the dangers of too much financialization, and for a short time, it sparked renewed interest in tangible industrial production, though that revival didn't last long. Public policy responses to deindustrialization were, honestly, pretty inadequate throughout this period. Trade adjustment assistance programs offered only minimal help to displaced workers, and enterprise zones or other development incentives just couldn't stop the migration of manufacturing. By 2000, the United States still lacked a coherent industrial policy to address deep competitive challenges. Environmental cleanup costs at former industrial sites often ended up being higher than the land's potential value for redevelopment. Cleveland's Cuyahoga River cleanup, while symbolically important, took decades and billions of dollars for only modest economic returns, showing just how tough it was to reindustrialize abandoned sites. Global value chains got more and more complex, with individual products now containing components from dozens of countries. This fragmentation made it really hard to measure the true economic impact of manufacturing decisions, and it created vulnerabilities to supply chain disruptions that would become clear in the decades ahead. Corporate tax rates also dropped a lot during this period, from 48% in 1970 to 35% by 2000. And plenty of loopholes and offshore tax shelters meant many corporations paid much less than the official rate. These policies ended up enriching shareholders, but they reduced public resources for industrial workforce development and infrastructure investment. By the year 2000, the United States had shifted from being the world's leading industrial producer to increasingly relying on imports for manufactured goods that used to be made domestically. This fundamental change, which began with the end of the gold standard and sped up thanks to technological change, globalization, and new corporate strategies, set the stage for the industrial challenges that would shape the 21st century economy. Thank you for watching.